There are a large number of investors who invest using technical analysis. We are not going to debate whether that works or not, but we are going to talk about what is the basic idea. Why does it work, if at all it works, when it works, right? So there is a basic idea which is governing, or the philosophy of technical analysis is that the prices and volume of a particular market instrument is governed simply by supply and demand, right? So there is no fundamental, there is no macroeconomy, there is nothing. Everything that you want to understand about a particular instrument is in the price and volume. There is no further information required to analyze that particular instrument. So this is the basic idea, and the price moves because of two kinds of participants, both rational and irrational, right? So in the CAPM model, every investor is assumed to be rational, where they're looking for their own best. But in the case of technical analysis, they make a distinction that not all investors are rational, some are irrational too. And therefore, they feel that the actions of both rational and irrational investors are produced as supply and demand dynamics, which drive the price and volume, and hence you can understand from those two pieces of information alone what is the expected technical outcome of that particular stock. The next basic idea that is the tenet of technical investing is that price adjustments are not instantaneous. So even if there is a news or a particular outcome, it takes a while before it's actually priced in. It can be a short while. It can be pretty short, like few 10 minutes to few tens of minutes, but it can be few days and months, even years, in the case of currencies. So the idea here is that the adjustments are not instantaneous, and the price actually moves in trend. So there is enough time for somebody who's observing these supply and demand dynamics to ride on these trends, and then eventually have an outcome where they are right in terms of the direction of the price movement. And finally, the most important part of technical analysis is that it's usually based on the idea of weak market hypothesis. There are three kinds of market hypothesis: weak, semi-strong, and strong. In the strong market hypothesis, it's public information is fully priced in. Even private information cannot change the outcome of the market. You can think of this as the fact that even if you had the best private information of a car maker, which is a gasoline car maker in US, and you pitted that against the price movements of Nvidia, irrespective of how much inside information you hold, you would still be underperforming Nvidia in the recent terms. So that's a case of strong markets where even private information does not give you any edge. In the case of semi-strong, it is believed that private information does have an edge. Public information is fully priced in. This is where most regulators function, where any action based on unpublished price-sensitive information is illegal. And hence regulators believe that the market is a semi-strong market. Technical investors believe markets are a weak market, where price alone has latent information, and hence they trade on that particular aspect of price movement. So, what we have to understand is that this supply and demand is governed by both rational and irrational investors. Sometimes the movement can be irrational, but the basic, again, tenet of technical analysis is that you can detect this alone from the market action. So all you need is a market price feed and certain ideas about what the supply and demand is looking like, and that is enough for you to trade in the market. So these are the different ways people look at market. It's more philosophical. There's plenty of literature available which is testing all of these ideas. We are not particularly against any kind of philosophy. We just want to make the best understanding of markets available for all our investors. So thanks for watching, and see you again.